afternoon, everyone. My name is Catherine, and I'd like to start by thanking you all for joining us today for what will no doubt be a very informative session on how to get cash out of your business in the most tax-efficient way. I'm very pleased to welcome my colleagues, Nick Wright, who's our Corporate Tax Manager, and Paul Heaven, who heads up our Corporate Finance Division, and they will be taking us through the presentation shortly. Just before we begin, I'd like to start by quickly running through some housekeeping, although I'm sure you're all very familiar with this by now. Today you are joining us in listen-only mode, so your microphones and webcams are automatically disabled. If you have any questions as we go through the presentation, you will find a Q&A box on your screen. If you type your message in here, then Nick and Paul will pick up any questions at the end during the Q&A session. There is a tick box which will enable you to ask your questions anonymously if you would prefer. I also just want to let you know that this session is being recorded and we will make it available to you over the coming days. That's all from me now. I'm going to hand over to Nick, who will take us through the presentation. Nick, thank you very much, and over to you.
Thank you, Catherine. As Catherine said, I'm Nick Wright, Corporate Tax Manager, so I deal with kind of the technical side and any technical advice, exit planning, company restructures, that kind of thing. So today we're looking at how to extract cash from the business. So we've separated the slides really into two sections. The first being cash extraction in an ongoing business, so salary, dividends, pensions, and slightly more complex planning as well, and then we'll move on to exit planning, or what might not necessarily be a complete exit, but at least giving up a proportion of your share capital in order to extract cash at beneficial capital gains tax rates. Excuse me. So the first and probably most simplistic method, and what I imagine a lot of you probably are already following, is a salary versus dividends method. What this means is generally you'll look at taking a low salary out. We often look at going up to the national insurance class 1 bands, at which point you're not paying any national insurance, neither is potentially the company, but you can still qualify for your state pension and state benefits at a certain level. So anywhere between, I think it's about 5.5 and 8.5, 9.5 thousand, you'll qualify for your state pension and you get an additional qualifying year, but you don't pay national insurance. The one thing to caveat this with is obviously in the future, in the budget in March, we were talking about corporation tax rates going up to 25% potentially for companies making larger profits. So this really needs to be done on a case-by-case basis, as companies will obviously be paying different corporation tax rates. Salaries are tax deductible, whereas dividends are not. So if you are in a position where you're paying the higher corporation tax rates, it's important just to make sure that that kind of standard rule of a low salary, high dividend still applies in each tax year, and also the timing of when you take dividends can also be quite important. A couple of other things to mention which can catch people out is, firstly, obviously dividends must be paid out of distributable reserves of the company. If the company doesn't have reserves, then the company can't legally declare dividends. So it's important that if you are following this structure, if you make a significant loss in 1 year that might wipe out your reserves, or you do some other planning that might wipe out the reserves of the company, you might all of a sudden find yourself you can't pay dividends under the Companies Act, in which case you're stuck paying a salary. The other point is, if there's more than one shareholder, it's important to make sure that the share capital of the company is set up in the correct way to do this. You can, in theory, if you've got, say, a 50-50 shareholding and only one shareholder is going to receive dividends, maybe the other shareholder isn't involved in the day-to-day running of the business, then if they're both got the same class of shares, and you want to pay a dividend to just one person, then you'll be looking at dividend waivers, which is not looked on favourably by HMRC, and potentially there's some anti-avoidance rules that could kick in. So in that situation, we would normally recommend that you've got two separate classes of shares, an A share and a B share, and therefore the company only needs to declare dividends on the A shares, and it doesn't matter about using dividend waivers. The other downside of dividend waivers is that you do need, as I'm going back to the distributable reserves point, you do need reserves to cover both the dividend that is actually paid and the waiver at the date it's waived. So theoretically, if we go back to the 50-50 example, if you're paying a dividend of say £10,000, you need the £10,000 reserves, plus you need the £10,000 that's been waived by the other shareholder, so a total of 20,000 reserves required in that case. So there's a few points there just to be aware of, but as I say, generally the low salary, high dividend is quite a common method of extracting cash in the most beneficial way that you can. And just to kind of move on to the next slide and show you the kind of an idea of the kind of marginal tax rates that you might pay. If I could have the next slide, Catherine. I think this one runs a bit slowly, so apologies if it's lagging behind a bit. But really the idea of the slide that hopefully will come on your, there we go, it's on now. You'll see there's just a few bands to be aware of where, especially this, as you can see there in the middle, that band sticking out 100,000 to 125,140 is where your personal allowance will be tapered. So if you're paying yourself anywhere in between that bracket or above, the income that you receive in that bracket will be taxed at an effective tax rate of 60%. These tax rates are based on assuming a salary, because obviously the dividend tax rates are slightly different at 7.5, 32.5 and 38.1. But the general rule there is that, or the message is the same, that if you are above 100,000, your personal allowance is tapered for every £2 you go over, you lose £1 of personal allowance, and therefore you've got an effective tax rate that's a lot higher than the 32.5% that you would be paying as a higher rate taxpayer. So that's where some dividend and some remuneration planning can come in. Maybe you don't pay yourself a dividend or as high a dividend in the one tax year to make sure you stay below the 100,000, and then you pay yourself sort of more that you go sort of way over the personal allowance, and so you're only having to go over once every other year, and avoiding that 60% band. So moving on to another remuneration strategy, which I think a lot of people do take up, because pension contributions are one of the most tax efficient methods. Obviously it's a bit more restrictive, although in recent years that's got better and better. So you now can flexibly access pensions from the age of 55. So certainly if you're sort of around that age and you're looking to get some cash out of the business, then putting cash into a pension tax efficiently and then being able to withdraw a lump sum or draw down on the pension after the age of 55 could be a beneficial route. There's a number of ways you can put money into pension. Certainly on the topic we're talking about, the most likely method you'd be going down is company contributions. So the company gets a tax deduction, especially if we're again going back to the new rates from April 23. If the company's in a 25% tax band, then the company's saving 25% on the amount that it puts into the pension for you, and then there's no benefit in kind for the employee either. So a very good and tax efficient method of saving, and as I say, with the flexi access rules, there's some you can get that sooner than you retire in certain cases. The other method of making contributions are personal contributions. So rather than it being a tax deduction for the company and a tax-free benefit for the employee, personal contributions work in a different way, in that a basic rate taxpayer obtains relief by only having to put in 80% of the contribution, and the other 20% is topped up within the pension itself. And then for the higher rate taxpayers, as well as the top up, then your higher rate tax band will get extended by the gross pension contribution. So that's the 80% you put in plus the extra 20% that's added. Meaning, obviously, if you're putting in significant amounts of pension, then the remaining of your salary and dividends can be taxed at the basic rate band. The other point to make in terms of pension contributions is that you have an annual allowance. So this is 40,000. It does get tapered where your adjusted income is very high. So if your adjusted income exceeds 240,000, as with the personal allowance for income tax rates, then the pension annual allowance will also start to get tapered down. But you also have carry forward for up to 3 years. The one rule to be aware of: if you've never used pension contributions in the past, then you won't be entitled to the carry forward. But assuming you have, and maybe you just haven't for the last few years, or sort of last 5 to 10 years or something, you haven't put money into a pension, you still get that 3-year brought forward. So if it's not something you've done for a while, and yet the company has got a lot of cash and you want to put that into your own estate or wealth, then using a pension contribution, you could technically have up to 160,000 that you could invest in the first tax year, and then obviously each year that carry forward gets rolled on a year. So you might not have 160,000, maybe you've got 100,000, so you want to put some in, and then you've still got some of the following year with the previous 2 years to invest more. So there's a lot of scope for pension contributions, and as I say, it's probably one of the most tax efficient methods of taking money out of a company, certainly whilst you're sort of still running and not looking to retire. Moving on now to grandparent trust planning. This is a more specialist area, but certainly if you've got children, then being able to fund some of the costs required for them using a grandparent trust planning can save a significant amount. We often look at this and think of this as planning in terms of paying for maybe private school fees, but there's no restriction that it has to be specifically for school fees. It can be to sort of fund anything really. And the reason we say grandparent trust planning is that it can't work for parents themselves because of anti-avoidance rules that stop parents giving assets to their children, or to their minor children, I should say. They can still give them to adult children, but parents can't give to minor children because the income would be assessed back on the parent anyway because of those anti-avoidance rules. So that's where the grandparent comes in. The grandparent would buy shares for the market value in the company. We'd normally look at sort of a minimum of about 5% of the company that the grandparent acquires. They have to pay full market value to avoid any other anti-avoidance rules kicking in, and it can't be a gift directly from the parents. It has to be a payment from the grandparent to the company at market value. Those shares then become reclassified. So as I said before, when we were talking about using A and B shares, so they'll have a separate class of shares, and then the grandparents can gift those shares to the grandchildren. We'd often use a trust in this case because obviously with minor children you don't just want to give them any shareholding, or even if it's only 5%, that they can technically control, because then it's up to them how they use those funds rather than the parent and grandparents themselves. So generally, for protection purposes, we would look for the grandparents to gift those shares into a trust. That gift should be tax-free using gift relief options, and then that trust can receive dividends, utilise the children's tax bands, which obviously if they've got no other income, certainly sort of if we're talking school-age children, they quite likely don't have any other income, so we can utilise their personal allowance and basic rate bands, and use that as a mechanism for paying for things like school fees. As I say, really this is more of a specialist area, so certainly get in touch if this is something that you think might be useful for you, because there's, as I've sort of said already, there's a few anti-avoidance rules that you need to make sure, whilst this is a completely legitimate sort of tax planning method, and it's not the most uncommon, you still want to make sure that you're not going to run into any obstacles on the way and end up that the parent does end up having the tax charge anyway and completely invalidate the planning. So that's grandparent trust. So just a few other points to kind of mention. If you've got a property that the company uses that's held outside of the company, if you own it personally, then charging a rent to the company may be a way of extracting funds. Obviously, rental income is not subject to national insurance as well. So the same as the benefit for the dividends, there's no national insurance charge. But you do need to be careful because it can impact on, as we'll come on to, the rules of business asset disposal relief. If you, in the future, you come to sell your business and you want to sell the property at the same time, having charged a market rent for the property will restrict the amount of gain that qualifies for business asset disposal relief. That might not be a problem. Obviously, last March, they reduced the lifetime allowance for business asset disposal relief to £1 million. So gains over £1 million will no longer qualify. At current capital gains rates, we're looking at 20%. So it might be that charging a rent now, you expect to sell the shares in the company for more than £1 million, and therefore you'll have fully utilised business asset disposal relief, and you don't need to worry about that. Interest, if you've made a loan to a company, then the company can pay interest on that loan. It's sort of, again, so it's similar to rental income in that it's taxable at your standard income tax rates. A slight benefit there, though, is obviously the savings nil rate bands of depending on your marginal tax band. So up to £1,000 interest can be paid tax free. And again, for interest and rental income, both will be tax deductible for the company. So a benefit for the company as well. And finally, directors' loan accounts. So if you're looking to or have injected funds in the past, or the company maybe needs some investment, rather than putting that in as share capital, leaving it outstanding as a loan will allow you to draw down on the profits or the excess cash that the company makes by paying down the loan instead. Again, that's something you want to look at in a bit more detail, really, because depending on your current shareholding or depending on where the business is, it might be that actually injecting funds through EIS and SEIS investment schemes might be more applicable, because those are very tax efficient. They can give you capital gains exemptions, and they can reduce your income tax liability. So it really depends sort of where you are at in the life cycle of the business as to whether you look at just injecting funds as a director's loan account that you're going to draw down tax free in the future, or if actually using EIS, SEIS venture capital schemes are more applicable, and obviously benefit from the income tax savings that those provide. So that's really sort of a very quick overview of the ongoing remuneration options that might be available to you. To move on to the sort of exit strategies, or at least reducing share investments, I'll first start by just going through a brief outline of the business asset disposal relief rules, which up until March 2020, we were looking at entrepreneurs relief. So they decided, along with reducing the lifetime allowance from 10 million to 1 million, they decided to rename it for no other reason that I guess it's now called bad relief, which maybe has some negative connotations for people, I don't know. Anyway, so business asset disposal relief, in order to qualify, you need to have held the shares and meet the conditions for at least 2 years up to the date of disposal. So you can see there the conditions. It needs to be a personal company. That means you need to hold at least 5% of the company. There's a number of tests to look at there. That's distributable income, that is share capital, nominal value and voting rights, and that kind of thing. So That needs to have been held for at least 2 years. It needs to be a trading company. Generally, it's okay if you've got some income in there that might not be trading in nature. So you might have a rental property that just earns a small amount. But what we've got to be careful of, so in terms of to be a trading, it needs to do trading activities, and it needs to do that at least 80% of its assets, income, management time, that kind of thing has to be trading in nature. So if you are holding something that's not trading, or if you're receiving income that's not trading income, it's an investment income, maybe you hold shares in other companies, sort of PLCs, or you have an investment portfolio, then that can't make up more than 20% of the business itself. HMRC will look at this in the round, so there's no sort of hard and fast rule. The 80-20 test is one that HMRC have kind of advised is what they tend to use. That's not written into legislation, so perhaps more of an argument to be had. But obviously, if you're claiming business asset disposal relief, you want to try and make sure that there's no issues HMRC can come back on. So as I say, you might have a significant, for instance, cash is again another grey area. You might have a significant cash balance. In theory, if you've got a lot of cash that's not required for the trading purpose of the company, then HMRC could have an argument for saying, well, actually, that cash balance as a percentage of the rest of the assets of the balance sheet is actually more than 20%, and therefore we don't think this is a trading company. But in terms of cash, I've seen a lot of theory about whether or not that argument can be had. I've not actually seen that really picked up in practice. So I think the key points, if you are holding a lot of cash, which you might be if you're sort of trying to hold a lot of cash to take out of capital gains tax rates when you retire, the main thing to point out there is don't do anything that could give HMRC an argument that it is an investment rather than simply being held as part of the trading company's assets. So suggestions for that would be making sure you don't invest it, you don't have it in a savings account, leave it as a deposit account. Obviously, you might lose out on a bit of interest by doing that, but that interest, certainly at the current rates, is likely to be a lot less than the cost of losing business asset disposal relief. HMRC also consider the intention of directors. So if you're holding a lot of cash, but actually you can say, well, we're holding a lot of cash because we're looking to reinvest this in the trade and we've got these plans, then that's another reason to ensure it's a trading company. And the final key condition for business asset disposal relief is that you need to be an employee or officer. A couple of times I've seen people get caught out where maybe they've been an employee and they've been given their P45 a day before sale. So actually the next day they do the sale, they're not an employee for up to 2 years, up to the date of sale. So HMRC do take that point quite strictly, the up to 2 year point. So make sure that you meet those rules all the way up to sale. Don't resign as a director prior to sale. Do that all on the same day so that HMRC can't raise any issue in the future. Moving on then, so the second slide we've got on business asset disposal relief is just a few planning opportunities you might use. The key one, a transfer to spouse. Certainly with all these kind of exit planning, you always want to look at doing this as soon as you can so that you qualify for that 2 year period. Transfer shares to your spouse. Spouse transfers are at no gain, no loss for capital gains purposes. Maybe they could be a director or a company secretary, or just if they are doing any work in the business, sort of have a minimal salary. There's no sort of de minimis limit here. They can have whatever they, and so they could have, sort of do a bit of admin for 5k a year or something, and that would qualify them. So you'd have 2 lifetime allowances at that point, so 2 million qualifying instead of 1. Again, you could transfer shares to children. There's a bit more involved there because that's not automatically no gain, no loss. But certainly trading companies should qualify for gift relief. So effectively the gain is transferred to the children for when they come to sell the shares in the future. So as it says, their lifetime limit 1 million. So that could be sort of shared between other family members in higher value companies. But the most important thing there is make sure you remember that 2-year holding period. Time is getting on, so I'll just run through some of these exit planning strategies fairly quickly. The first one, a management buyout. This is probably one of the most common methods we see, other than straightforward sales. A lot of the time, managers and shareholders want to pass their shares on to people they know. Maybe there's long-standing managers in the business that you know will take the business forward and share the same ideals as you. So management buyouts kind of help to carry on what you've built over the last sort of years, in many cases decades. So in that kind of case, in the example you can see here, you've got a husband and wife owning 50-50. You want to transfer those shares onto the managers. So the managers would incorporate a new company, which would be used as a special purpose vehicle to acquire the shares off the husband and wife in TradeCo. So as Paul will come on to, there's a number of ways to finance that. The new holding company could acquire external finance. They could use loan notes, so husband and wife acquire loan notes and get paid out of the future profits over a period of time. There might be already some cash reserves in the company that you can take out and hive up to holdco and pay to husband and wife, or preference shares could be used instead of loan notes. And as you can see there, it might be used for a full exit, so just the two managers carry on the business, or husband and wife can retain a minority shareholding as well. And this can work for family and third-party managers as well. So as I say, that's quite a common one that we do see quite regularly being utilised. Moving on to the next slide, a company purchase of own shares. The company itself can repurchase shares from any shareholder. The standard rule for that, though, is that a company purchase of own shares is an income distribution, so it's effectively paid as a dividend. So when we're looking at tax planning for company purchase of own shares, we're always looking at trying to meet the conditions for it to be a capital distribution instead of income. So those conditions are in the legislation. That is that, again, it has to be a trading company. They have to hold the shares for at least 5 years in this case. They need to reduce their interest in the company by 25% and immediately cease to be connected. So that's having less than 30%. And most importantly, from HMRC's perspective, there needs to be a reason for the company to do it. It needs to benefit the trade. So often a retiring shareholder or a troublesome shareholder is a perfectly legitimate reason for buying back shares and allowing the company to carry on trading after that shareholder is retired. But there are some, obviously, ceasing connection means that the company needs to buy the shares immediately. In the case of husband and wife companies, that can be a problem because husband and wives and other family members are treated as connected themselves. So if you've got husband and wife, husband wants to buy out his entire shareholding, then the wife has 100% shareholding moving forward. That won't work because technically they're still connected by their personal relationship, and therefore it's still an income distribution. There's other issues to be aware of as well. So that 5-year holding period, if the shares were acquired following the death of a shareholder, that reduces to 3 years. There's one we're working on at the moment where that's the case, but actually that's working in our favour because they were actually only held for 4 years at the time of death. So the shareholder wouldn't have qualified for company purchase of own shares, but actually the deceased, the wife of the deceased, does qualify. So there's a few issues to be aware of there as well. And as I say, the company needs to immediately repurchase the shares, and it needs to be paid for in cash. But there are a couple of mechanisms that you can utilise if the company doesn't have that cash on day one to pay it out in tranches. So just to be aware that that option is still available to you. If normally we look at tranches up to 4 years. If the company needs the time to raise the funds, then it can do so. Another one for passing shares on to the management team is an employee ownership trust. This is, I would say, utilised less because there are more restrictions, but it has some very significant tax benefits. So an employee ownership trust is where the shareholders pass the shares basically into the ownership of the employees, but via a trust. The trust will pay full market value for them. And there's no CGT charge for the sellers. So other than the fact that there's no CGT charge, the employees can also receive a bonus from the trust each year up to 3,600, and that'll be tax free. And as I've said with the others, there is also the mechanism for the shareholders to be paid out of future profits and deferring the payments, or again, the trust can obtain external finance. There are conditions applying to that. It needs to be a trading company, which is a common theme with a lot of tax reliefs. There's the all employee benefit requirement, which I think tends to scupper this planning, because generally you've got a couple of managers who you think would be really good to pass the shares on to, where you'd look at doing an MBO. But in this case, all employees need to benefit from the trust. There are a few exceptions. So, for instance, employees with less than a year's service don't need to benefit, but generally it's an all-employee rule. Controlling interest requirements, another condition, which means at the date of the transaction, the trust needs to acquire more than 50% of the share capital as part of the deal. And then the limited participation requirement, which is the number of continuing shareholders cannot exceed 40% of the total number of employees. And as I say there is allowance to maintain a minority interest, normally up to about 5%, as kind of for sentimental reasons. And that obviously then allows the exiting shareholders to receive dividends in the future if that's beneficial to everybody. And finally, I see I'm I've gone a bit over time, so I'll race through this one a bit. But if there are no other options, if simply selling the shares to a third party or selling them on to existing managers and shareholders doesn't work, then there's the liquidation winding up route. So distributions within a liquidation will always be capital, or 99% of the time be capital distributions. And therefore, if either the business has reached a natural end, or if there's no one to pass it on to, then a liquidator can be appointed to realise all the assets and pay the remaining cash and the value out of the business at capital gains tax rates and business asset disposal relief. We did talk about business asset disposal relief needing to be 2 years and needing to be trading up to 2 years. So there is an exemption in liquidations whereby, as long as the company and all those conditions we went through meet the criteria up to the date the company ceases to trade, the company then has 3 years to realise its assets and make those distributions. So yeah, there is a bit of a relaxation there for the sake of relaxations and being able to qualify for bad relief. And I think that's probably all we've really got time for to go through now. There's plenty there, so obviously if you do want to go through any of this in any more detail, if any of those options looks appealing, obviously get in touch and we can sort of have a chat in more detail of how this might work in practice. But for now, I'll just pass over to Paul to go through some of the corporate finance side of this.
Thanks, Nick. Hi, everybody. I'm Paul Heaven, and as previously noted, I'm the head of the corporate finance team at Jerroms. So we work with owner managers who are looking to buy a business, sell a business, or raise finance for their business. My role in the context of this webinar really is to talk about the funding available to deal with some of those exit options. A number of you may have been on the webinar thinking, well, some of these ideas are great, but my senior managers or even my wife or brother or partner or husband simply doesn't have the resources to finance this. What I'm going to do is take you through some options where the business itself can be used to secure the finance necessary to undertake the transaction that Nick has described. So next slide, please, Catherine. So I'm going to cover off 3 forms of finance. I'm going to do so quite zoomily, but I'll hopefully cover them enough information to give you some proper feedback. So I'm going to cover debt, I'm going to look at equity, and I'm going to look at mezzanine as an option. The latter will be one that you're probably least familiar with, but let's run through them. So the first one then, thanks Catherine, is debt. That there are as many forms of debt as there are almost kind of days of the month. So there are lots of different forms of it. Many of these you'll be familiar with, but using the assets of the business to secure the finance is quite a common approach to leveraging the finance necessary to facilitate one of those acquisition or buyout options that Nick described. And that includes hire purchase, term loans, using the debtor book for invoice discounting or factoring, putting in place some kind of a stock finance facility, supply chain finance and so forth. There are some local and regional finance options, and generally speaking, they're quite keen to look at, particularly the management type led buyout options. The one mentioned down there is the Midlands Engine Investment Fund, or MEIF, and then a couple of the providers within that scheme would be quite keen to look at those options. Crowdfunding can be used for the purpose again, and many of you may be familiar with some of the crowdfunding lending platforms. Funding Circle probably being the most famous. And then there's something called the CDFIs, which were Community Development Finance Institutions. We're blessed with 3 in the region of the West Midlands, but they are dotted around the country, and they can be used for funding, typically for up to about 250,000, sometimes a little less, but that's quite common. So next slide, please, Catherine. So in terms of the types of debt, fundamentally they fall into 2 categories: secured debt, unsecured debt. Remember, the lenders primarily are interested in security and serviceability. So in terms of security, secured debt will be something that's asset backed. You'll be familiar, I'm sure, with property backed, mortgages and the likes, hire purchase and so forth for plant and equipment, invoice discounting, factoring for debtors. So these are all asset backed. Generally speaking, there's an option to be able to secure the finance against a particular asset. There is an option to use what's called a floating charge, which will be a charge against all assets of the company. It's a less popular option, but it will be one that probably in a belt and braces arrangement many lenders will seek in addition to some sort of fixed charge or registered charge. That's simply where they're able to identify the asset. So that belt and braces approach is quite common. Unsecured debt that's secured by a personal guarantee won't feel very unsecured to the person providing the personal guarantee, but it is regarded, it's one of those weirdnesses of the world of finance, will be treated by the lenders as being unsecured debt because it's not fixed against a particular asset. But don't enter into personal guarantees lightly on the assumption that they're unsecured debt, because generally speaking, in the pantheon of collection, the lenders will suddenly regard it as a very secure form of debt and go after your own assets and property. There's sometimes a principle of skin in the game here. So what I put in there is as a reference is the fact that we sometimes do. I'm doing a deal at the moment where the amount of funding involved in the deal is £1 million, and actually we can probably do. In fact, we almost certainly can do all of that lending out of secured debt of some description or another. But the lenders are looking for the people that are coming in that instance, to put some of their own money in the mix. So even though in theory it could all be done through secured debt, they are looking for a 50k contribution from the incoming team in terms of their own skin. And that can take the form of a personal loan, an investment in equity, or it could take the form of some sort of guarantee they give or charge they give over that 50k. So next slide, please, Catherine. So equity, again, you'll all be familiar, I'm sure, with equity. Share of ownership of the business, generally speaking, doesn't require security. Again, for buyout options, very, very popular. There's a lot of funders out there that are looking for management buyout to back management buyout teams and provide equity. They are committed as opposed to involved in the business. The famous English breakfast analogy, what was the saying? The hen was involved, but the pig was committed. They are committed investors. They're in there for the long term. It is a bit more complicated to arrange and will involve some complicated legal agreements called the shareholder agreement and articles. Some of them will seek some kind of a non-executive directorship position, and they will therefore be, if you like, keeping a close eye on what's going on with the business. It is high risk because there's no guarantee of any returns, and once the money's in, there's almost no way of them getting it back out again. So they will expect a high return, and they are therefore looking for businesses that have got both a plan ultimately to grow the business and sell, but also businesses with the potential to grow with that kind of high return potential. Next slide, please, Catherine. So in terms of mezzanine, this is the one that's probably least familiar with you. As almost the name implies, it sort of sticks between equity and debt. It kind of hovers somewhere in between. It would generally have, if you like, obligations for there to be repayment, although not uncommonly with a 1 year, sometimes even a 2 year repayment holiday. How do they price the risk of the fact that they're participating in a very high risk instrument here into the pricing of it? Well, they'll very often do that either in the form of an equity option. That works particularly well where there's 50-50 owners and the money's coming in, and the provider of the money doesn't really want to find themselves in a situation where they're one day called upon to choose sides. So they'll instead take their equity return in the form of an option, which won't materialize, it won't crystallize until exit occurs. So in between time, the two 50-50 shareholders get on with figuring out how to compromise with one another, and the equity provider in that instance won't see their upside return, the equity return, until exit. In that instance, they may reserve some equity conversion rights. Not uncommon if the business is early stage that they're actually putting in money which has got a kind of equity type risk flavour to it. So they'll be lending you the money, but they may well take some kind of equity conversion rights. The other common method is a redemption premium. We did quite famously, we loaned money from a regional mezzanine fund a couple of years ago to fund a management buyout, and in that particular case there was a hefty redemption premium if the loan had gone to its term, which was 5 years, but the redemption premium was reduced if the loan was repaid after 4 or after 3 or after 2 years, and indeed in that instance it was repaid in less than 2 years. So they are taking equity risk. They will therefore price that into the product, but again can be very useful in the kind of transactions Nick was describing earlier. There aren't that many providers of MES, but it is becoming more popular. We do happen to be blessed with, for a region actually in the West Midlands, a higher proportion than most are, and we do have 2 or 3 mezzanine providers in the West Midlands, including the government-backed Future Fund scheme. So next slide, please, Catherine. What kind of things are they looking for? Actually, interestingly enough, almost completely the opposite. Debt, they're looking for boring serviceability, showing long track record of the business being able to generate sufficient profits to pay back the loan. They're looking for security. They like businesses that are predictable, that are reliable, certain, steady, and low risk. Equity on the other end of the spectrum is completely the opposite. They're looking for high growth, ability to scale, a huge market that they're going into, innovation, IP, and that isn't a misprint. I mean, there was a study done of equity providers, and they were asked to rank the 3 highest priorities that they chose investments on the basis of, and the number one priority came back as management, number two as management, and number three as management. So they're looking for the skills of the management team, the roundedness of the management team, the experience of the management team. So they're looking for exciting businesses with great opportunity to grow. They're not at the very risky end of the spectrum, contrary to popular myth. They're looking at medium risk. But interestingly, the question posed to the bottom of that slide is, would you produce the same plan for both? I think the answer is sort of self-evident, really, that the answer is very definitely not. You do a different plan for each of those two. And it's not uncommon, by the way, for us to go to both and sometimes do a funding with a blend of each. Right, next please, slide please. And then really kind of, you know, before we get into some of the exit planning options, what kind of things to watch out for? Debt, you've got to be careful of the terms, clearly. Rules on early repayment, sometimes they can be quite draconian. Not many people know this, but Funding Circle calls for an all or nothing early repayment. So there are no options to do bullet payments on Funding Circle. Arrangement fees, again, watch out for them. Administration and service fees, again, those of you familiar with invoice discounting and debt factoring arrangements will know that actually they very often dwarf the interest that they charge. Fixed or variable rates of interest, and again, being mindful of what might happen in the future on interest rates. And deeds of priority, so there'll be some kind of balancing act between who has the greatest priority on exit if there's a if ever there's a failure event. Equity, as previously mentioned, there's some complex agreements in there, including the shareholder agreement, the investment agreement, almost invariably a new set of articles. There'll be what's known as a prohibited activity list. So the money can't be used for any purpose. It has to be used to benefit the trade. So they'll draw up a list of things that can't be done without their consent. And sadly, buying Ferraris, at least for the business owners anyway, isn't an option. There'll be some warranties and indemnities. And again, these things aren't cheap to arrange. So there'll be arrangement fees, sometimes monitoring fees and non-exec fees. And it can feel like it's quite an expensive form of finance. Next slide, please, Catherine. In terms of exit planning, then, again, just, you know, it's all about planning, and the word there really that to emphasize is planning. So the earlier you get an opportunity to think about how you're going to do this, how to optimize the value of the business, you know, what bits of the trade you may or may not continue with if you're going to extract the maximum value of the business, is now a good time to be opening up a new, I don't know, a new production line or a new factory if you're thinking of exiting in the next few years and you're not unlikely to see a return on that. So it's a timing issue. If we are going to get involved in external buyers, then we do need to get involved in a formal process to get the external buyers engaged to make sure that the best terms are achievable. And obviously from Nick's point of view, the earlier you can be thinking about the taxation planning, the better. I mean, I'm going to just share with you, and I promise you go through the whole of it, but I'm just going to show you the next slide, which is the slide we use when we talk to people about what a sales mandate looks like. Now, you'll be relieved to know in the relatively short period of time we've got left, I'm not going to go through every one of those pillars of a sale mandate process where we're looking at an external buyer, and many of those blocks will be things that we'll do even if the buyer is, you know, your husband, your wife, your brother, your son, daughter, grandparents. There are certain of those things which, including the formal valuation process, making sure that all the key value drivers have been identified. You know, these are things that we're going to be getting involved with irrespective of whether we go external or not. So these are some of the steps that's involved in a full-blown external sales mandate process. We do run a separate seminar entirely on that process of selling your business, so I won't attempt to do that in the relatively short space of time available. But those are the pillars of a well mapped out, well thought through, and you know, properly initiated sales mandate process. Okay, so the key message really from my part of today's webinar is, if you are looking at any of those exit options that Nick outlined earlier, where we're looking at potentially selling part of the business to a family member or a management team or whatever, don't be thinking in terms of what finance they have at their disposal. It's not unimportant, and they may be called to put some skin in the game, but the primary driver here is what assets are available to the business that we can secure to leverage that that buyout process. And hopefully what I've articulated in this relatively short period of time is there are plenty of options, and we'd be only too happy to explore them with you. So I think that's me done in terms of the how do we fund it, and I think we're into Q&A. So, Catherine, are there any questions posted up?
That's great. Thanks very much, Paul. Yes, we did have a question earlier that was, let me just have a look. So in terms of just going back to Nick's point about grandparent planning, there was a query about how do we calculate the value of those shares that the grandparent will buy? And is there a way that this can be minimised?
The answer to the second part is yes. So going back to the grandparent trust, I said that they need to pay full market value for the shares. So it will require a formal valuation. Obviously, we'll be in this kind of planning, we're always looking to try and minimise the valuation that we come up with, so that obviously the grandparents don't need to come up with too much cash themselves to fund it. There's always obviously ways to reimburse the grandparents sort of further down the line. For instance, if the grandparents are buying shares, then they can always receive a dividend in the future. But in terms of how we're going to value it, we would firstly, obviously, as I say, we do a formal valuation. By no means, if they're acquiring, say, 5% of £1 million business, they are not going to be needing to pay anywhere near £50,000. So i.e. the immediate pro rata for 5%. We'll look at various different methods of valuation, earnings-based valuations, looking at the forecast. So if there's anything in the forecast, meaning that the profits that have, the historical profits aren't going to be as great in the near future, then obviously that will give us a good rationale for reducing it. But one of the key kind of things that we'll do to look at getting that valuation as low as possible is to apply a discount, because obviously the value of a controlling stake in a business or 100% value is not the same as having a minority 5% where you have no say over the direction of the business moving forward. So really anything up to sort of 75% discount on the shares and the valuation, I think, is perfectly reasonable for such a minority holding. So that £50,000 we can already get down sort of by 75% to more like 12,500, for instance, in that example. But as I say, we'd look at various different methods, and obviously Paul, jump in if there's anything else to add, because I know you're more the valuation side than me. But you know, we'll look at various different valuations, and we'll be looking at applying pretty heavy discounts for the basis that they don't have control, etc.
That's pretty much covers it well, Nick. Yeah, and Nick, as Nick alluded to, it's not uncommon for Jerroms on Nick's side to commission us, the corporate finance team, to assist with those formal valuations, because getting an external valuation opinion, even from an independent team within the Jerroms group, is not a bad practice. And Nick's exactly right. I think the minority discount is the most obvious one, but you can look at the rights attached to the shares. You could make the shares when they're set up as a new class to have non-voting rights. You can have them as shares that don't have any preemption rights. So there's all kinds of things that can be done, which as a consequence thereof, reduce their open market value, the market valuation that is sought by the revenue is their open market valuation. What would a person in the open market buy? And a 5% shareholding, particularly if it were non-voting of a private company, is not going to have a very high attractive rate in the open market.
That's great. Thank you very much. That's a really good, thorough response from you both. We have just had another question come through. Can you purchase non-commercial property as an asset and then have the rent paid to the company?
When we say non-commercial, I assume we're talking about residential property. Really, for it to be paid to the company needs to either purchase it directly, or they would need some sort of license or bare trust nominee arrangement in order to have the income go through the company. If the property itself is owned by the individual, just on the face of it, then no, the company has no rights to that income. I guess then you need to kind of think about the wider implications. So purchasing a property, if you're purchasing it via a corporate structure, then obviously stamp duty, land tax will kick in. They've got higher tax rates, so immediately there's the 3% higher SDLT rate. Also need to look at something called annual tax and envelope dwellings, ATED. So if the property is worth more than 500,000, then there's a potential additional tax charge under ATED. Although there's plenty of exemptions, but if it's just bought as a rental property and it's rented out, then there's no ATED charge, there's an exemption from it. So there's a lot to think about when you're looking at property, but if you're purchasing it just to rent it out to the company either needs to use it themselves or sublet it. So yeah, there's probably a wider planning thing to look at, really, I would say there, but in theory there are mechanisms for doing it. I think the main thing is how beneficial is it to do it would be the thing you want to look at in the first instance.
That's great, thank you. Anything to add, Paul? Or?
Not really. I mean, it's more of a Nick question than mine. I mean, I think that the wholly and exclusivity rule applies. I mean, we definitely have, clients that have what we would think of as being residential property on their books, but generally speaking, it's because there's some rationale within the business for why they would seek to own such a property, to house workers that are serving the business. Maybe in the case of a couple of our businesses, because that is the business of the company. They buy and they loan money and buy residential properties and then let them out, student accommodation, that kind of thing. So I think it's got to be thought of in the round of what is the trade of the company and how logical does it appear to be that they have a residential property. But very much a question for Nick, not me.
Yeah, I think just to add to that as well, obviously we've talked about business asset disposal relief. So if the company if this is sort of non-trading, either a non-trading asset or at least a non-trading income, then we need to be careful not to, if it is a trading company, not to taint that trading status and lose out on reliefs such as business asset disposal relief. And as I alluded to throughout the webinar, there's lots of different tax conditions throughout the legislation that requires a company to be trading. So things like inheritance tax also comes in here with business property relief, gift relief, company purchase of own shares. So whatever we do in terms of whenever we do anything where we're looking at what might not be a trading asset, we always want to consider how relevant those other reliefs will be and if it's going to be a concern.
That's great. I think that quite nicely brings everything to a close, really. Just wanted to say thank you to everyone for joining today this afternoon. I hope that you found it really useful. Thanks, of course, to Nick and Paul for their very informative session. Thank you very much, everyone, and take care.
Thanks, guys.